Before we begin, here's how to earn continuing professional education credit for attending this session. Gain valuable insights by attending the podcast, then complete the assessment test to download your certificate. To do this, follow these simple steps. Click on the link in your description to access the session. Create a free account and attend the podcast. After the podcast, take the assessment test and download your certificate. It's easy, and it's free. We highly recommend checking out our subscription.
So, we definitely want you to shed some light on that, but also for our viewers, because, when we initially spoke, even I asked this question, and I think everybody ought to know this, because I asked this seriously, I have no clue what is reverse mortgage. Explain it to
Okay.
me like a layman. I know what's a
Sure.
mortgage. I need to buy a house and
Yeah.
I take a mortgage, but what's a reverse mortgage?
Yes. So I will go with the current definition, which is a variation of the program, which is today called the HECM, or the Home Equity Conversion Mortgage.
Okay.
A very different tool than what was used in the past. So when reverse mortgages began in the industry, was really the first reverse mortgage was 1961 in the United States. Now, other countries have had versions of this. In any country where you have a rising real estate value, there's always the potential of home equity or value within a home to either find access to or utilize at some level at some point in time. We're not the only country that has this. England has this, Australia does. They all have different versions of this. But in our country, we had I would call it a very poor start to the program. So the first reverse was actually issued in 1961. For roughly 20 plus years until 1988. We call it the Wild West of the industry. It was really dangerous time to get a reverse mortgage because no one else knew what to call it. So that's just what they call it, right?
Welcome to today's episode of your favorite podcast, We're Trying to Figure Out with Saul. I'm your host, Saul, and joining us today is Nathan Johnson, a seasoned reverse mortgage specialist. Nathan, thank you for being here with us.
Absolutely. Happy to be here, Saul. Thanks for the invite.
Absolutely. For our viewers, a little bit about Nathan. Nathan has a unique perspective on reverse mortgages, not just as a professional, but also from a personal experience, having helped his parents navigate their financial planning. Today, he's here to help us understand how new reverse mortgages can be a strategic tool for managing finances in retirement. So, let's get into it. Nathan, let's
Sure.
from the beginning, can you just share with us your personal journey into this world of reverse mortgages?
Yes. Well, started in 2002, and I was hired by a small mortgage company, kind of family owned, and they had the vision to say, well, we feel this could be a program of the future. Currently, there's still a lot of work to be done. But we wanted to hire you, so they hired me. I didn't even know how to spell mortgage. I had not done any work in the mortgage world at all. I had been in different sales positions, had been in some nonprofit work prior, but they saw that I had a side to me that they felt could really be helpful for working with seniors. And so a little bit of a backdrop to that is when I was growing up, I know it sounds a little bit unusual, but my grandmother was one of my best friends, and she was just a huge support for me growing up, right? She always said I was her favorite grandkid, so that didn't hurt. So she was just a wonderful person, and she would just let me in on all the stuff going on with aging, right? And so we would talk about it all the time, and I never got tired of listening to her, talking to her, listening to her stories about growing up and literally eating potatoes every day, literally sharing shoes. I'm not kidding you. She grew up in Minnesota, very cold weather, just some very interesting stories. So anyway, background was I've always kind of had sort of an affiliation or just a desire to want to help. And so when I started this program, from the day one, I felt I really want to take care of folks like I would my grandmother, my grandfather, and my parents. And so that was the initial launch into the care portion of this, which is a very important, I would say, characteristic to have if you're going to work with maturing homeowners, we call them now. We're not seniors. They don't they don't really want to be called seniors unless they're getting a discount on something maybe that would be senior related. But so when I started in 2002, I was given this sort of here's the objectives of the programs. Here's kind of what we're trying to accomplish, and was launched. However, it was not a very kind entry. Everyone that I would mention the word reverse mortgage to was like, you go into a room and you turn on the light and the cockroaches like take off. Everyone just like leaves the room. And so I was very discouraged I would say first 3 months,
Yeah.
and the owner of the company just said, just give it some time. This is going to be a long education process.
Yeah.
However, I said, well, what have you gotten me into here, right? What
Yeah.
have I dove into here? And I did a lot of research and a lot of sort of reading and studying on really what the problems were at the time, which
Yeah.
we'll talk in a little bit. But there was a lot of misconceptions. So really, I started my career in educating, and I haven't stopped. I've been doing this collectively now, going on to my 16th year in the fall.
Wow.
And I love what I get to do with clients, and also the referral partners, with financial advisors, their CPAs. Sometimes a lot of referrals come from other folks in the mortgage industry that just don't want to deal with this, right? Because our education cycle is very different, right? You have a lot more hurdles to overcome. So that was kind of how I got started. And I've had some good success with the program, but really my success is more about the lives that I've helped change, and from multimillionaires all the way to folks that could barely make their mortgage payment. So
Wow, that's interesting.
yeah,
I mean, it's incredible, how, like you just mentioned, how personal experiences can really shape our professional lives. And
yes,
I'm pretty certain that, these experiences have also, changed your initial perceptions of reverse mortgage. So, we definitely want you to shed some light on that, but also for our viewers, because when we initially spoke, even I asked you this question, and I think everybody ought to know this, because I asked you this. Seriously, I have no clue what is reverse mortgage. Explain it to
okay,
me like a layman. I know what's a mortgage.
sure,
I need to buy a house and
yeah,
I take a mortgage, but what's a reverse mortgage?
yes. So I will go with the current definition, which is a variation of the program, which is today called the HECM, or the Home Equity Conversion Mortgage.
Okay.
A very different tool than what was used in the past. So when reverse mortgages began in the industry, was really the first reverse mortgage was 1961 in the United States. Now, other countries have had versions of this. In any country where you have a rising real estate value, there's always the potential of home equity
Yep.
or value within a home to either find access to or utilize at some level at some point in time.
Yeah.
We're not the only country that has this. England has this, Australia does. They all have different versions of this. But in our country, we had I would call it a very poor start to the program. So
Okay.
the first reverse was actually issued in 1961. For roughly 20 plus years until 1988. We
Mhm.
call it the Wild West of the industry. It was really dangerous time to get a reverse mortgage because no one else knew what to call it. So that's just what they called it, right? Well, let's just call it a reverse because it's a mortgage and then it's going backwards. But it doesn't really define it very well. And it was quite a dangerous product back then. And the reason being is when lenders established this program, there was no rules and regulations on costs, fees, rate structures. And the worst part about it was that if somebody was looking at a reverse mortgage back then, the only security instrument the lender felt they needed or had to have in place was a title transfer. So
Right.
when that homeowner was looking at trying to access some money within the home because they had built up equity in the home, but more likely the market had increased, right? You talk to some of my clients and they're like, yeah, I bought my home for 12,000 and now it's worth 600,000. Well, that's home equity, that's housing wealth.
Yep.
But back then, there was no real safe way to access it other than to transfer that title to the lender, the bank, or the private investor, whoever it might be.
So that happens
That
at
is
face value.
dangerous.
Right? Like,
What was that?
so that happens at face value. Like
Yes.
when transfers, it's like face value. Like if I bought it at 12,000 maybe in 1944, and I
Yes.
come to it in 1980, I'm still doing it at the same rate at which I bought it at 1944. Is
Yeah.
it?
So it would be there would be an appraised value back in that time. There would have been, okay, I bought the home for real cheap and now it's gone up in value. And maybe it wasn't as significantly high as they are today because home
Okay.
values just have really ratcheted up quite a bit, right?
Okay.
But what we saw was this, okay, I want to access some of the money in there, but if they did that, it was quite a dangerous proposition, right? It'd be like if you said, okay, I've got a car here. I'm going to sign my title over to a stranger.
Yep.
Well, that stranger now owns your car because they own the title. The same thing would be with your home.
Yep.
So not only the banks had control of that entity, but they could change it at any time. They would write in all kinds of clauses that would make it advantageous for the bank. So fast forward to 1988. Actually, in 1987, Ronald Reagan signed the HECM into law. It was ratified in 1988. We didn't actually have our first HECM reverse mortgage until 1989. So it literally took that gap of time for someone to go, okay, I'll try one of these because I've heard bad things. And that is still happening to this day. So
Yep.
there are still people really caught in some old, outdated information.
Yep.
And rightly so in some cases, right? There were some really bad reverse mortgages that were written. Now, did we fix everything in 1988? No, there are still misappropriations of reverse, or people take money out and they probably should have conserved more. But in general, the program has made leaps and bounds outside of that era of time that was pretty dangerous. So all that to say, the HECM reverse mortgage, which is what we always direct people to that name,
Yep.
home equity conversion mortgage, FHA insured, regulated. It's the most regulated loan by far in the United States. And we have about a third more documents that clients sign. They actually have to go through counseling. There's a whole series of protections for the client, as well as FHA and HUD insurance on the program, or called mortgage insurance. So anyway, just to kind of give you a little bit of a backdrop, today, though, the HECM is going to lend a percentage of the home value. So those are the things that we have to establish first. So what does a reverse mortgage do? Well, we give clients or home owners access to housing wealth or home equity. But we don't give it all because that would be dangerous, right? We don't give all the money because then they could spend it all. We give them a percentage based upon their age. So if they're a little younger, you got to be 62 to the entrance. At least one of the homeowners has to be 62. And then we give more money the older that the client might be, based upon really three factors. So age, expected interest rates, and also the third would be the appraised value. So that's the general concept of accessing some of those funds. And there's all kinds of ways you can obtain those funds, but that's the real kind of the backdrop and then what we're dealing with today. So hopefully that's good.
Do you want to earn CPE credit? Take this course of MyCPE 1 to earn free credit. Click the link in the description to get started.
No, absolutely. I think that makes perfect sense. If you're not really, like, I won't really call it senior, but like, if you're at an age of 62 and you're applying for it, there's a life expectancy. So obviously, the probability of that amount to be utilized would be for a longer duration. So that's how you equate it, and you want to be cognizant about that. That's all what financial planning is all about, right? Because you don't think about it when you're taking these things. So, you put in a very interesting point. All right.
Hmm.
And 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 I'm glad that you brought this out. When I didn't know that this has been going on for so long. I didn't hear about it until 2019 was when I first heard about it.
Okay.
Okay. Well,
Okay. Sure.
I had no clue about it. But
Yeah.
I'm glad that we're talking. So, I would just want to up the ante, and I would definitely want to, know more about the misconceptions that we have with reverse
Yes.
mortgages. So what are some of the biggest myths that you encounter in your work in terms of reverse mortgages?
I would probably highlight three or four. The first one is when, and we still hear this to this day, and there's still folks that are, probably well-meaning and trying to help protect people, but they are way over, I would say overprotected, but they're also basing a lot of their data on that 61 to 87, 88 era, right? So the first one that you'll hear, and about 50% of the time, this is probably the number one. I don't want to do a reverse mortgage because the bank is going to own my home.
Uh-huh.
Well, where does that come from? 1961,
You want the title
71,
transfer.
81,
Yeah.
right? Because the bank would take the title, which was the ownership, right? So the bank and lender to this day in the HECM program never owns the house. It's simply a lien against the property, just like any mortgage would be. The lien at the end of the reverse mortgage is satisfied either by the sale of the home or if the client pays off the reverse for whatever reason or passes away, eventually the reverse gets satisfied, just like any lien would, any mortgage lien. So there's really no difference. So that's probably the first one is I'm going to lose my house. The bank's going to take it. You actually have to work extremely hard for a bank to, for a reverse mortgage lender to take your home. Okay. And that wouldn't even be taking the home. It would be foreclosure. The ways that you can be in trouble is if you stop paying property taxes, you stop paying your homeowner's insurance, and you just never keep the property up. In other words, a tree falls on the house, you never fix it.
Yeah.
Well, those are all things that a homeowner, any responsible homeowner, is going to do already, right? You're going to pay your property taxes, or you're going to have a tax lien, right? You're going to pay your insurance because if you don't have home insurance, your house burns down. Well, there goes your house, right? You got no value there. You just got the land.
Right. That's true.
So these are all responsible home ownership ideals that everyone's going to maintain anyway. And so those are really the only qualifications. And then that they stay in it as their primary residence.
Yeah, absolutely.
So it's not meant for second homes, vacation homes, although I have quite a few clients that have second homes, vacation homes, but this is their primary residence that they're securing their HECM reverse mortgage on. So that's the first one.
Yep.
Losing my house. Second one is a lot of folks think that the costs of the reverse mortgage are extreme or high. I hear that a lot. And actually, we are very comparable to a traditional mortgage. On one side of the fees, we have all the traditional fees you're going to have, title insurance, appraisal fees, credit reports, that type of thing. We also have an origination fee that's going to be very comparable to a traditional mortgage. The only piece that we have that's more expensive is the mortgage insurance premium, or the MIP. And the MIP is really a structure that does two things essentially. The reason it's expensive is you actually want this to be in place versus in the traditional mortgage world, an MIP is really kind of a necessary bother, right? We don't really want it there. We're going to try to get our LTV to 80% or less than 80%, less than 80%. So then the MIP falls off. Great. We have a smaller mortgage payment now. That is in the traditional mortgage world. It's only there to really protect the lender. Well, FHA took that concept and they really expanded on it. And they made it such that the MIP is a very robust insurance policy. And really what it does is it is a 2% cost. So let's say home value comes in at 500,000 for even math, that's $10,000. That MIP does not stay with the lender. That actually travels to FHA and HUD, and they have a account that they've been saving for years, called the MIP, or the Mortgage Insurance Premium Account, that protects all FHA loans in the country. Okay.
Nice.
But that's about 5 billion now. So it's been working its way up, and it's very substantial.
Yep.
But what it does is it does really, the engine behind our program, and there's protections. So let me explain that real quick, because this is where a lot of people go by, and I see it. Unfortunately, there's a lot of reverse mortgage salespeople out there, and they just talk to clients and they say, well, just deal with it. It's just a cost.
Yeah.
So stop belly aching and just,
Yeah.
it's part of the program. Well, they don't really explain it very well. And so it does get this little bit of a bad rap. So let me explain it.
Absolutely.
The engine behind our program really is, without it, we would be back to that 61, 71, 81 era, because the lender has no real secure, any way to secure the repayment of this loan at some point down the road. So
Okay.
with a true HECM, most of my clients, once they've obtained it, they've secured it, they never make a payment again.
Yeah.
So if you're thinking of a lender and that you've lent out, say, $100,000, and that client's never made a payment, well, how does the lender make their money? Well, they make their money at the end of the loan.
Yep.
Whereas a traditional mortgage lender makes their money in the beginning, right? That's why they like to have you refinance every other year if you can, because you just reset the 30 years and they make more money on interest and all that. But it's just the mortgage world, right? That's what we've accepted.
Yeah.
However, the reverse is different. So we have to account for, what if we have a worst case scenario and we've had this home value growing for a while, and then all of a sudden the market takes a dive.
Oh.
Our home value has gone down. Our loan amount is actually maybe in a worst case scenario, again, the perfect storm.
Yep.
What if we're upside down? We owe more on
Yep.
our reverse mortgage than we can sell the home for. So let's call it $50,000 shortfall. That $50,000 is paid for by this account from FHA and HUD. They actually write a check to the lender at closing.
Yep.
So that MIP is really there as the engine. It makes our program work. Without it, we wouldn't even have a program. We wouldn't even have this wonderful time together. Okay.
Nice.
The other piece is that there's actually 7 protections that come with that.
Nice.
So the first protection is called a non-recourse loan. It means that the lender can never come back and ask from the borrower additional funds. So the lender is protected. So non-recourse loan. The borrower is also protected. So the homeowner, the borrower, is protected. So they're never going to have debt to pay on the home outside of what the home would sell for. In
Yep.
very simple terms, we say the home will always take care of the loan. That's it. Very simple.
Yep.
Also, they won't pass on any debt to their heirs. So
Yep.
that's the third protection. First lender, second borrower, third heirs are protected. The fourth is the servicing of the loan is also protected. So if the lender goes out of business for whatever reason, the borrower never experiences any shortfall. Basically, the funds keep coming. If they've set up a monthly draw, that draw continues to pay. If they've got money in the line of credit that's available, their monthly statements continue. All of that goes unaffected. Okay, so servicing is protected. Also, these are 2 pieces. Well, I would say the next 3 are very important. Monthly payments. So if a client has set up a monthly payment, like an annuity draw type, it's a type of an annuity, it pays on a regular basis. If they've set that up, that payment is also protected, no matter what happens in the market.
Yep.
If the market goes up or the market goes down, interest rates go up, interest rates go down, it doesn't matter, is unaffected. What's
Nice.
also important is the line of credit and the line of credit growth are also protected inside of the mortgage insurance premium. So it makes the loan program work on the engine side, but it provides all those 7 protections. Now, what's most significant about this line of credit is that I've got clients setting up lines of credit of 200, 300,000 or so.
Right.
And that's because they have higher valued homes, but they're setting up this line of credit. That line of credit cannot be frozen, reduced, stopped. It's always available. And that is because of this MIP. So when people talk about this as an added expense, it is an added expense. But if we didn't have it, we wouldn't have the program and we wouldn't have the protections.
Absolutely.
So there you go. That's a much longer answer to number two. Number three, I will probably hear this a lot, is people say, well, reverse mortgages are really for folks that are desperate, or this is the last result of, a retirement just gone sour, or people didn't save enough money. So we're using this as the last resort.
I heard that a lot. I heard that a lot. A lot of people.
You hear that a lot. That's right. That is completely false. Okay. Now we do help a lot of folks that maybe haven't saved enough, or they've got a mortgage they're carrying into retirement. It's just a burden for them every month. They're having to pay this money out and they're on a fixed income.
Yep.
When we talk about retirement income planning, there's a hero in our world named Wade Pfau. He's a financial advisor. He wrote a book on reverse mortgages. It is in its third edition. I highly recommend you go out. Now, this is not, and I would say it's not an easy breezy read, right? This is a document. This is data driven, Monte Carlo simulator driven book. And what it was really designed to do is to say, well, Wade started hearing all this stuff in the market, like reverse mortgages are terrible, never do them, or the opposite. Yes, everyone should have one. Well, that's really not true. Again, these are the two extremes, right?
Yeah.
But what he did is he said, I'm gonna actually do some research here. And he hired a team and they did this simulator, and they basically found through all the different data that they did and the different situations. And one of the situations would be never do reverse. The other extreme would be doing right away. What they found is over this time frame that a reverse mortgage, if used properly, again, a HECM reverse mortgage used properly, can help support and grow a retirement account, because we use it for a lot of different things. For some people are using it for tax efficiency. Some people are using it for sequence of return risk. Others are just simply using it for the rainy day fund. Instead of drawing funds from their retirement, when they need it, they've got this other asset that's tax-free, so it doesn't affect their tax bracket. Absolutely. And so these are all the things that he discovered. And so he kind of launched this book, and I would recommend anyone to get this book. It's very interesting. Again, it's going to read more like a research project, but very, very, very good data. So all that means is my highest net worth client to this day, 6 million.
Wow.
So let that sink in a little bit, because most people think, well, this is for the little old ladies from Pasadena that has, and yes, we do help those folks too. And I love them. I love helping clients. I just had a guy in here recently who's, retired. He's got a little bit of Social Security. He's still got a mortgage. We're going to get rid of his mortgage payment. He's still going to have about close to 45,000 in a line of credit that's there for him. And we are changing his retirement. But that is for more of a needs base, right? We're not talking about that necessarily for every one of my clients. About 50% are needs based. The other 50% are using it for many other uses, sometimes retirement income planning, sometimes legacy planning, sometimes purchasing a new home. Whether they're buying up or they're relocating, you can actually buy a home with a HECM. Now, at Mutual of Omaha, we call that a lifestyle home loan. We got a lot of confusion when people would call it a HECM for purchase. They're like, well, do I do a HECM and then take the money out and buy a home? I'm not sure. So we actually rebranded the whole name of the program, calling it Lifestyle Home Loan. But I have done this for my mom. I've done this for my father-in-law, helping them in a sense to relocate to a better home situation or a better home for them, or to be closer to family. So there's your three. I probably went a little longer on those three, but we probably covered some other ground that you may have been asking, but those are probably the three. Again, to review, the first would be, I never want to do a HECM because I'm going to have my home taken by the bank. Not true. Second would be reverse mortgages are expensive. We've explained that. There's a reason why there's the MYP. It has to be there. But compared to a traditional mortgage, very, very similar, except for the MIP cost. And the third would simply be a reverse mortgage is really for folks that desperately need one. And the
Yep.
truth is about 50% of the clients that are securing the HECM reverse today are in a completely different category than the ones that really need to do something.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.
Wow, wow, this is amazing. And I remember you also talking about, some people also talking about, when especially when they explain the cost and everything, they're not talking much about the MIP and everything. They're just like, oh, it's a cost, we'll take care of it and everything. And it's
Yeah.
actually this, it's this misinformation that has actually become a barrier, and you have been facing this like day in, day out,
Many, many years, yes.
Yeah, many years. Now probably you know it because you've handled these objections for quite a while, so you know how to set the things right and everything. But then
Yes.
there's an ethical part to it, right? Because you get
Yes.
exposed to a lot of information, right? And then there's a challenge, there's misinformation, there's a challenge on how you tackle it, and this
Yes.
misinformation and this pressure selling and everything when you're consulting with your clients, right? So how do you
Mm.
tackle with all this misinformation and pressure selling when you're consulting with your clients?
I am so glad you asked that question. I would say in our industry, when I entered the industry, the other thing that I noticed in 2002 was that this was kind of lumped in as another mortgage product, right?
Yeah,
So unfortunately, the mortgage world has become more and more transactional, right? You can get a loan online. You don't have to even talk to somebody, right?
yeah,
Well, that's really not how our industry was designed. It really is still a people industry. It's a relationship industry. It's a high trust and a high confidence industry, but it has moved transactional in the traditional mortgage world. Unfortunately, that has affected our world as well. So
hmm,
there are folks that will try to sell you a reverse mortgage online or never seeing you. I just had a gentleman that I encouraged him to stay with his loan, but I had to literally tell him what he was doing. He had gotten in line with a California lender that had no idea what he was doing. He had probably only originated a handful of these. He had no idea what he had signed on his documents. He didn't know what the MIP was. He didn't even know what his line of credit was. He had no concept. And
yeah.
that's because he was sold the idea of a reverse as, hey, you're just going to pay off your mortgage and don't worry about the rest. But
Oh,
that there was more to it. He still had close to $30,000 in a line of credit that he was never explained how
yeah.
this would work. So he almost left his lender, but I said, you know what? You're right there. You're almost ready to close. Let me just go through the documents with you and let you know that what you're signing is okay. And here's how this works. And if you have questions afterwards, you can call me. Now, that I'm not making a dime from that because another lender is
Yeah,
that didn't do his job. I
yeah,
did the job for the lender. However, that is very common in our industry. And unfortunately, what we've seen in the industry creep in is this under education and an overselling at the same time.
right.
And when I started, I said, I'm going to do the opposite. I'm going to overeducate and I'm going to way undersell this. In fact, we're not even going to call it a sales process. We're going to call it a discovery process.
Yep.
And so what I've been doing with clients from day one, so when a client comes in fact, I'm going to be launching some webinars in the future here that are going to be simply informational. People can hop in, stay anonymous. It's going to be a very, very basic 30 minutes with a little bit of Q&A at the end. But I found that people just need to have an entry level education and what they're afraid of, they don't really maybe even want to meet me face to face, and that's okay. But I
Mhm.
do encourage that at some point. So the discovery process is all education driven. It's let's talk about accurate information. How does this tool work? And the process that I've developed is that that's step number one. We are not actually taking an application day one. I won't do it.
Yeah.
Uh, in fact, most of my referral partners are financial advisors or financial professionals, And they really appreciate that. They don't want a
Yeah.
client to be pressured or oversold this product, right? Because it really is a financial tool. It's
Yep.
not just a mortgage product, and that's unfortunately the name it's obtained is this sort of it's another mortgage product. Just go ahead
Yeah.
and get it. Well, it's just not. I mean, I still have ongoing meetings with clients, so my process is discovery. Then we go into a design phase where we talk about how this works, how to budget for this, how to set this up, how to utilize the line of credit. And eventually when clients are ready, then we'll do an application. We'll go through the process. We'll get the HECM secured, but they're still not done yet because I have a lifetime policy with my clients. I will be available after the closing. We'll do annual or biannual reviews, whatever they want to do, because there's other things to do afterwards, right? There may
Yeah.
be, how do I use these funds? Or
Yeah.
can I grow my line of credit? How do I
Yeah.
do that, right?
Yep.
So the process for me is so important. And I
Wow.
teach this. I've had a team for a couple of years now, and I teach this process to the folks that work with me. And I feel it's the best way to do things. And so if you're going to work with a reverse person, make sure they're a specialist, make sure they have a process that's education and client driven, and it's on the client's timeline, not mine.
Yep.
So I had a client come to me 2.5 years ago, and they just weren't ready. They were unsure, they were a little uncomfortable. We went through the process, and they were still a little bit like, I don't know. I said, well,
Mm.
I'm here for other questions, whatever you have.
Yeah.
So about 3 months ago, they came back and they said, okay, we're ready. Let's
Uh-huh.
go.
Okay,
Right. And
nice.
so I had to, pull up their old data. We went
Yeah.
through the process again, just, reviewing everything. And
Absolutely.
it was great. I mean, they're so happy today. And that's okay because it took the time that they needed, not the sales process drove them to. If that makes any sense.
No,
So,
that makes perfect sense, And I guess, you certainly also put out misconception number 4 that a reverse mortgage will take care of your mortgage, like the existing mortgage. That's
oh
not
yeah.
that's not how it is. And it's funny you mentioned that because that's what I thought when I heard about it.
Mhm.
All right. When I heard about it, I mean, the term itself felt like, okay, I take a mortgage and then the reverse mortgage would be, all right, so my mortgage gets paid off through some way. Like I did get a fair idea about
Mm.
it. Like
Yeah.
maybe I bought a house in the year maybe 1980 for like $50,000 and I took a mortgage on it naturally. And now all that is
Mm.
paid off. And so eventually I ended up paying the bank maybe 100K with the interest and everything. But
Yep.
as of today, the value of that property is maybe 1 million.
Sure.
So against
Sure.
my 100K that I've totally paid, I still got like 900K more of value. And now, like I can use that equity. What is that? Home equity? That's the term that you use.
Mm-hmm.
I can use
Mm-hmm.
that home equity and I can get a loan if need be for whatever reasons, maybe a lifestyle loan or whatever the reasons may be, right? I could do that. But
Yes.
then I thought that, maybe, like I'm still paying the loan, but I'm not in a capacity to pay the loan. So, but I noticed that the value of my house has gone from 50,000 to today it stands at, I don't know, uh, 750K or something. So I'll just tell her, oh, why don't you just adjust it and just pay off my rest of the loan? Because that's what I thought. That's what I thought reverse mortgage is.
Uh-huh.
Until I later on came to know, no, that's not how it works because there's so many things involved. And you
Mm.
rightly pointed out,
Yep. Yep.
there's so many facets to it, and I'm just glad that you are clearing this out. It's really phenomenal. And you being a veteran in the industry, you've seen it all, you know the history, you know where we stand, and
Yes.
we know what the market is today, the real estate market today. It's
Yes.
crazy right now, so from an industry itself, where do you see this industry, what do you see currently, and where do you see this industry
Mm.
going? What's the current state?
Yeah. Great question. I would say right now that the three clients that we're helping the most would be someone that is still going into retirement or thinking about retirement, the slowdown phase, right? Because right now, there's a lot of people that are not super confident that they may have enough funds to really last, right? Life expectancy is high, but costs are going up, right? Even just simple property charges, real estate taxes, insurance, HOA dues, all that stuff, plus just the cost of food. I mean, like a bag and a half of groceries the other day, it cost me $100. I'm like, what is going on? And this
Wow.
used to only happen at Whole Foods, and now it's happening everywhere. So, sorry, just not a Whole
No, no,
Foods,
no,
but
absolutely.
good company. Just but what we're noticing is that with people dragging, in a sense, a mortgage into retirement. So the first thing we're going to look at is what do we have? What are the liens on the property? So hopefully there's no tax or workman's liens or anything like that. But we're just dealing with a mortgage. Maybe it's a first and maybe a small second, whatever it is. We're going to pay those off first. And so that's really money back into the client's pocket. Now they're
Right.
continuing to pay the taxes and insurance like they would, but they don't have the principal and interest payments. We're really going to defer those payments for I would say an undetermined amount of time. We don't know how long they're going to live, right?
Yeah.
But that would be the first type of client that we're still helping today is, can we at least eliminate the mortgage payment altogether? If we can do that, then we can help free up some cash. Now, if there's some money left over, so let's say an example is you got a $500,000 house, there's a $100,000 mortgage, and the reverse mortgage is going to yield, say, 175,000 total.
Yep.
So we take 100,000 of that 175, pay off the mortgage. We still have a line of credit of 75,000.
Yep.
So we can utilize that for anything. We can let it sit there and grow. Some of my clients have elected to make payments against the mortgage balance.
Yep.
Now only about 10% do. So I'm not saying everyone does this.
Yeah.
But the reason they would do that is if they pay down that $100,000 mortgage balance, plus of course costs are on top of that. But if they pay that down, say at the end of the year, they go, okay, I got an extra $5,000. I haven't made my mortgage payment for a while. I'm going to apply 5,000 towards the balance and pay that down. My line of credit of 75 now goes up
Oh, it
to
goes up.
80.
Okay.
Yeah.
Oh, yeah, because you added more funds into it. Yeah. Yeah.
That's
Yeah.
right. And that's how we do it. So if you pay down your reverse, dollar for dollar, that line of credit will grow. And
Yep.
so some clients will use that as, well, this is a great place to park some additional funds because it's tax-free over here
Yep.
on my line of credit.
Yep.
Over here, I'm paying it down. So I have a smaller loan balance. That's a positive. My line of credit's growing.
Yep.
So that would be one type of client. They're taking a mortgage into retirement. The second type of client is simply opening up a line of credit. We call this strategy the buy and hold technique, right? I'm going to literally open up a line of credit. I've got my home paid off. I just did this for some clients recently. Home value 950. Opened up a line of credit of about $340,000.
Mm-hmm.
We're going to let this line of credit grow. And right now, our growth rate, which is matching our interest rate, which is higher right now, we're at 7.5%.
Yep.
But historical data, we usually land between 4 and 6% on our interest rate. So let's say we have a 7.5% growth on the line of credit.
Yep.
Well, 340 at 7.5%, we just kind of spitball the numbers, but we get pretty close to about $28,000-$29,000 of growth conservatively on that 340.
Wow.
So a client's literally going, well, this is kind of a no-brainer. I'm just opening up the line of credit and letting it grow.
And that's tax-free.
Tax-free, absolutely.
Wow.
When they draw the funds out, it's tax-free.
Yeah.
And then if they draw the funds out, it adds to the loan balance,
Yeah.
but then they can pay it back down again. So which would increase the line of credit. So
Yeah.
it's incredibly flexible in what they want to do. And for a lot of clients, I mean, that becomes how I pay my property taxes, my insurance. That's my home renovation budget, right?
Yeah.
I got 20 some K in this account. Why not improve the house, right? Which doesn't hurt anything, right? Makes it better for long term.
Yeah.
So those are the two. And then I would say the third is really folks that are looking to purchase a home. And this can be clients that are looking to upsize their home. And that might be because their home that they've been in for a while, they want better amenities. They want a nicer home. They want everything on one level. One level homes, price per square foot, are
Yep.
more expensive.
Yep.
So when they're looking at this, they're not always looking to do downsizing. I have a client right now has a free and clear home at $400,000, and she's looking to buy a $750,000 home. So we're going to help her do that with a reverse purchase or a lifestyle home loan to
Nice.
help her move up. Another classic example would simply be a downsize. So my mom's scenario would be true. My dad died about 5 years ago. After he passed, mom had the home. She still had about 300,000 net equity in the home.
Mm-hmm.
She didn't really buy anything for 300,000, not in Colorado Springs. So she ended up buying a brand new home for 500,000. She brought about 225. The reverse purchase at that time was lending a little more cash, and
Yep.
it brought about 275.
Nice.
So at the end of the day, she gets a home for 500,000, brand new, everything on one level. All she's required to do is pay her taxes, her insurance. She has no mortgage payment, and
Yep.
she loves it. She's closer to my brother and I. It's perfect house for her. She doesn't have to even think about it. Her HOA takes care of all the lawn stuff, all the irrigation, no matter what, right? She's
Nice.
covered. So those are some examples. There's other examples of purchase, but that would probably be the three most common clients, right? Those folks that have a mortgage payment, taking that into retirement or a slowdown period, so paying that off. The second would be the buy and hold technique of taking out the line of credit on a free and clear home and just letting it grow. And the third would be using it to either upsize or downsize your home and getting a home that's going to better fit for retirement and the lifestyle that they want. So
interesting. Very, very interesting, and you've been an educator for a long time, it's a big part of who you are,
yeah,
And then
yeah,
I
love
know
it.
that, it's never a one-man show, right? There's cross-professional collaborations in your field, and, there are so many other players that you usually play around with, There is, because the real estate professionals, there are financial advisors, there are
Yes.
so many other things, right? But just from a curiosity standpoint, who do you usually like these cross-professional collaborations in your field? Who do you usually collaborate with? Is it with bankers? Is it with financial planners? Who is it that you most?
Great question.
Yeah.
I receive probably 30 to 35% of my referrals come from financial advisors.
Interesting.
Just advisors. I get a few others from estate planning attorneys, occasionally a CPA. I do get quite a bit from other banks and credit unions, because a lot of times getting a senior another loan, putting them into another payment is really not the best plan, right? So they're seeing that. I do get referrals from other mortgage brokers or bankers, right? That they don't want to mess with this. They're
Yeah.
focused on their work, and this just takes a very different process. And I tell people, you really can't do both of these. It's kind of like trying to be like a car insurance salesman and a financial advisor, right? They are very different hats to wear, and you have to slow the process down. And
Yeah.
the mortgage world is so fast moving. I always tell people it's kind of like the Matrix, when
Uh-huh.
Keanu Reeves does that freeze frame and then he
Yeah.
picks the bullets out of the air, right? So the mortgage world's like the bullets flying, and then my world reverse is like, okay, slow down.
Yeah.
We're going
You're
to
gonna
take some
matrix
time
it.
here.
You're gonna
We're going to
matrix
take these things out, right? This isn't true. This isn't true.
it.
Let's just take our time, because this is a big decision, right? This
Yeah.
isn't something you make online. Now, even though some people still do that.
Yeah.
So the process is different. So a lot of mortgage folks, I would say a lot of real estate agents too. Sometimes I actually help realtors with their own personal situation, because they understand home equity and the value of home growth, and they want to stay in their home. Other times it's clients that are looking to relocate or downsize. Those are probably the most common. And I still get quite a few from my past clients. I get a lot of referrals from past clients. So those would probably be the main categories. Every once in a while, maybe a home care company that the client just needs to be able to access more funds to stay at home. The oldest client I have did his first reverse mortgage. Probably should have done a little earlier, but 98 years old. And
Oh,
his daughters were like, "Okay, Dad, you're doing this because we're shelling out $1,000 a month, each of us, to pay for your care. We can't do it anymore." So we just basically set him up with a monthly payment. It paid his home health care costs, and it set him up in a really good position. So
Well,
anyway, those are probably the type of clients that I work with, or the referral partners. And sometimes it comes from really, other industries that I don't always expect. Sometimes it might be a handyman, or it might be a neighbor of a friend who just said,
yeah,
"Hey,
I was going to say that.
versus
Like random people, or maybe like, hey,
random."
what? I
Yeah,
know my friend Nathan, he does this. Why don't you go talk to him? Give my name. What's not?
that's right.
Yeah, but I'm just gonna not. I'm not gonna go take much of your time. There's just this one question that has popped in my head. I'm not sure if
Sure.
it's true or not, but if you can just tell me if it's true or not. With the home refinancing stuff that you can do with the reverse mortgage, right? The lifestyle loan. Is it
Yes.
necessary for those individuals? Like if I'm in Florida, is it necessary for me to buy a house in Florida itself, or can I buy that house in Utah, or maybe I
Mhm.
don't know, shift to Latin America or something, live as an
Great.
expat or something.
Yeah. So we have only a few simple rules when it comes to the HECM program. One is it's a primary residence loan.
Yep.
So if you choose to say, okay, I want to stay in Florida, but I want to buy a second home in Colorado or something like that, or vice versa, there's not a problem with that. As
Yep.
long as you're in that home for technically 6 months and 1 day,
Yep.
right? Where you vote, it's where you pay your
181. Yeah.
taxes, right? All that.
Yeah.
That helps determine primary residence. But I have a
Yes.
lot of clients that have other homes. Like one really interesting story. I had a client uh, that purchased a new home, and he had so much money left over because he didn't have to use all of his funds.
Yep.
He ended up buying a cabin for his family in another city about 2 miles away, called Ouray, Colorado. If you ever want to Google it, it's one of the most beautiful. We call it Little Switzerland here in Colorado. It's gorgeous, beautiful place.
Yeah.
So he bought this cabin, which was a lifetime goal and dream.
Yeah.
And what's fun is he ended up moving back down to Arizona to follow his kids. So I helped him with another purchase down there.
Yeah.
But now he's in Arizona, and he's in Arizona about 6 months, maybe 7 months out of the year. But guess where he comes in the summertime?
The
You're right.
guy.
Because you don't want to be in Arizona in the summertime, right? Or you can be, but if you
Yeah.
have an option to be in cooler climate,
Why
you're gonna
not?
yeah. So anyway, that's a great question. I get that a lot. And the good thing is with Mutual of Omaha, we basically lend in virtually every single state within the United States. So even if a client is not in the state that I am licensed in, so I'm licensed in Colorado, Arizona, New Mexico, and also Wyoming. But if they're outside of that, I help clients still. I still do my discovery process. Everything is the same thing. I just network with one of the local LOs that's a Mutual of Omaha reverse specialist in that city, and we can work and kind of do it. We call joint work or together work. We work
Yeah,
together with
absolutely.
the client. So there's nothing the client doesn't have to worry about, am I going to talk to like 8 different people? No, I'll still be a point guy, and we'll work on this together. So anyway,
Fantastic. Fantastic. All right, Nathan, we're going to be wrapping this up. It's been
okay.
interesting, learning about the nuances. But before I let you go, any final thoughts or advice for our listeners considering this option?
Yes, I would say one of the things that we talk about a lot in the industry is the timing. Like, when do I do this? So this all sounds great. When do I do this? Well, one thing that I encourage folks to do is don't try to time the market, right? You have to make a decision based on, is this a good plan now? And if I engage with this now, you can always refinance a reverse mortgage down the road. But if this makes sense, um, if you try to wait for the market to get better or market to change, what often happens is there's other elements that happen. It's kind of like project management. Really, there's
Yeah.
kind of three elements that there are with all decision making: time, money, and quality, or quality of life. And if something happens to that triangle, and let's say somebody has the pressure of time now, oops, I got to make a decision, and there's some financial pressure as well, and there's a quality of life issue. It's really hard to make a good decision when you have those I would say combining factors or conflicting factors. So I always encourage people make a true assessment. If you do want to look at this as a 2-year or 3-year, we can do those assessments too. I have a tool that helps people visualize that to say, okay, what does it look like in 2 years or 5 years?
Yeah.
The youngest client I've had come to me to do this analysis was 52, my age.
Wow.
They're going, Nathan, how do I plan? I really want to do a reverse when I'm 62. What do I need to do to get rid of my mortgage so I can open up this line of credit? So we talked about it, right? Here's what you can pay down your mortgage, or maybe you have some other accounts you want to add to and eliminate the mortgage, or maybe we go in with, you still have 50,000 left on it. I don't know.
Absolutely.
But we can do some projections for clients that can help them figure out down the road. But that would be the one thing I see a lot of people trying to time the market, and it's just hard to do that. So if you think it's a good idea, let's go through the process and at least go, if nothing else, let's develop a plan for maybe in the future we'll look at it. That's okay too. But
Absolutely. What's the harm? I mean, you at least want to know what it's about. If you have an
Yep.
option ready, you know what can be done, So absolutely, thank you. That was really enlightening. So thank you,
Good.
Nathan, for joining
Thank you,
us.
Saul.
Yeah.
It's been a
And
pleasure.
yep. And thank you for sharing your expertise. And for our viewers, until next time, keep exploring your options to unlock a financially stable and fulfilling retirement. Until then, goodbye. Cheers.
Thank you.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.